Markets were positive in March. Equities up, bonds up. Not massively, but marginally so. Year to date, equities are up roughly 5%. Bonds, government bonds, up between 2 and 3%. It's a pretty positive story, notwithstanding all of the negative headlines we've been reading. I'm joined by Dean Cook to try and make sense of this all. Dean, we've committed in our weekly series that the first episode of each month is going to be a quick overview of what's going on in markets, which is what we're doing today. Give everyone a very snappy update on what's been driving things. I guess my question to you is, how can it be the case that we have such negative headlines and yet positive returns? So what are the key themes driving things?
Thanks, Shane. I think maybe we should start with the context of the first 3 months of the year relative to last year. So last year was a very difficult environment for investors. So some of what we've seen in the year to date is a bit of a bounce back from those quite bad markets. Then I think in terms of what's driven the markets in the first 3 months of the year, you can broadly categorize it into three themes: inflation, interest rates, and the banking sector. So if we start with inflation, things are beginning to look better. Why is that? Well, energy prices, for one, have been coming down, so that's helped headline inflation come back a bit. Core inflation remains sticky, so there's sort of wages and things involved there, and that tells you that central banks probably still have a bit of a way to go yet on interest rates.
Okay, so inflation becoming a bit stickier. I'm hearing quite a bit about that. It's a question. We all know it's coming down, but how quickly is it going to come down, or will it get stuck on the way down? Yeah, so we're linking this to interest rates, because that's where the big story is always at. If we have elevated levels of inflation still, are we going to see elevated levels of interest rates for the foreseeable?
You've outlined the central bank's conundrum perfectly. Inflation is still higher than target. So whilst we might have maybe seen a slower pace of interest rate hikes in the nearer future, we're certainly, I guess, nearer the end than the beginning in that regard. We've got two conflicting factors fighting. Inflation's higher than central banks want it to be, but things like the banking crisis that happened during the course of March are beginning to show that there's some sort of fragilities in the system that central banks need to pay attention to. Things like the banking sector provide important input into the economy. And so when things get tougher there, it causes a slowing of the economy anyway. Markets are starting to expect that rates could come down as early as July, which probably feels like it's a bit overcooked. But it tells you, as I say, that maybe we're nearer the end of the interest rate hiking cycle than the beginning.
Okay. So interest rates could be coming down by July, according to markets. Presumably that's in the US, right?
Yeah.
Market expectations. Okay, very interesting. So conflicting things, higher inflation, but fragility in the system. So a tricky one for central banks. Okay, just speaking on the banking crisis really quickly. I mean, I think the key question here is this a systemic problem, or is it kind of isolated to a few small incidents?
Yeah, we don't need to go into the specifics of what happened with Silicon Valley Bank and Credit Suisse. I think that's well understood now. But what it shows you is that interest rate rises can cause sort of cracks in the system, and it shows frailties and fragilities where they existed already, but under a bit of stress, they start to break. The main takeaway for us is that it doesn't appear to be a systemic issue at this stage. Obviously, lots of attention is being focused on making sure that particularly, say, regional banks in the US are getting a bit more regulatory oversight, but it seems to be that the banking system is now set up to deal with failures better than it was in the past. So there's more capital behind them, so they can withstand shocks to the system better than they could in the past.
Okay, quickly, what one thing to look out for in the weeks and maybe month ahead?
I guess the corporate earnings season will be interesting. That you've got pretty low expectations at the moment, which sort of counterintuitively help, because if companies beat them, then they can be rewarded with higher share prices. The banking sector, as we've just spoken about, is likely to be of keen interest and in the crosshairs of the market, because we're probably going to see it be more expensive for them to run their businesses, so higher costs, and therefore we might see a bit of a dent to earnings. How big that dent is probably too early to say.
Okay, so banks still one to watch. Inflation a little bit sticky. Interest rates maybe, just maybe, on the way down at some point later this year. Okay, put all that together, I guess you get something quite positive, which is what's reflected in markets. Let's hope that continues. We will be back next week with our usual format where we pick one topic out from what's going on in markets. Until then, take care.